The decision by the United Arab Emirates to leave OPEC in 2026 represents one of the most consequential shifts in global energy politics in decades. To understand the implications of this move, it is necessary to explore the historical role of OPEC, the UAE's motivations, the immediate and long-term effects on oil markets, and the broader geopolitical, economic, and environmental consequences. We take a comprehensive analysis of these dimensions, weaving together the threads of history, economics, and international relations to show how the UAE's departure reshapes the global energy order. The Organization of the Petroleum Exporting Countries, OPEC, was founded in 1960 by 5 nations: Saudi Arabia, Iran, Iraq, Kuwait, and Venezuela, with the goal of coordinating oil production policies to stabilize markets and secure fair revenues for producers. Over the decades, OPEC became synonymous with collective action in oil markets, wielding enormous influence over global prices. Its ability to impose production quotas allowed it to act as a cartel, balancing supply and demand and ensuring that member states benefited from higher revenues. At its peak, OPEC controlled more than half of the world's oil supply, and its decisions could send shockwaves through global economies. The UAE joined OPEC in 1967, aligning itself with the collective strategy of Gulf producers. For decades, Abu Dhabi adhered to OPEC's quotas, even when they constrained its ambitions. Yet tensions simmered beneath the surface. The UAE invested heavily in expanding its production capacity, building infrastructure to pump more oil than OPEC allowed. This mismatch between capacity and permitted output became a source of frustration, particularly as the country sought to diversify its economy and maximize revenues before the global energy transition reduced demand for hydrocarbons. The UAE's departure from OPEC was not a sudden decision, but the culmination of years of dissatisfaction. Several factors converged to push Abu Dhabi toward independence. First, production constraints imposed by OPEC limited the UAE's ability to exploit its full capacity. While the country had invested billions in expanding its output potential to nearly 5 million barrels per day, OPEC quotas restricted it to around 3.2 million. This gap represented lost revenue and diminished strategic autonomy. The UAE viewed these restrictions as unfair, particularly given its technological investments and efficiency compared to other producers. Second, geopolitical tensions within OPEC played a role. Saudi Arabia, the de facto leader of the organization, often dictated policy in ways that favored its own interests. The UAE increasingly saw itself as constrained by Riyadh's dominance, especially as regional rivalries intensified. The war with Iran and the blockade of the Strait of Hormuz underscored the fragility of Gulf unity, making collective decision-making less appealing. Third, the UAE's broader energy strategy emphasized diversification. Abu Dhabi has invested heavily in renewables, nuclear power, and hydrogen, positioning itself as a hybrid energy hub. Leaving OPEC allows it to pursue this strategy without being tied to a cartel that prioritizes oil above all else. By exiting, the UAE signaled its intention to chart a unique path that blends hydrocarbons with clean energy. Finally, the UAE's global partnerships influenced its decision. Strong ties with the United States, Israel, and India provided alternative avenues for energy trade and security. The oil for rupee arrangement with India, for example, aligns with de-dollarization trends and reduces dependence on Western financial systems. These partnerships gave the UAE confidence that it could thrive outside OPEC. In the short term, the UAE's exit had limited impact due to ongoing disruptions in the Strait of Hormuz. The war with Iran and the blockade of shipping routes constrained exports, meaning that production capacity could not be fully utilized. Oil prices remained volatile, driven more by geopolitical risk than by supply changes. However, the symbolic impact was significant. OPEC's credibility as a cohesive cartel was undermined. The departure of a major producer signaled to markets that collective discipline was weakening. Traders began to anticipate greater volatility with less certainty about future supply decisions. This uncertainty itself contributed to price fluctuations, as markets adjusted to a new reality in which OPEC's influence was diminished. As shipping routes normalize and the UAE ramps up production, the medium-term effects will become clearer. Independent UAE output could soften prices by increasing supply beyond OPEC's coordinated levels. This would benefit consumers but reduce revenues for producers who remain within the cartel. Countries like Saudi Arabia and Iraq may find themselves forced to cut production more deeply to stabilize prices, further straining OPEC's cohesion. The UAE's expansion to 5 million barrels per day by 2027 will test the limits of global demand. If other producers also increase output, oversupply could trigger price collapses reminiscent of the 1980s. Alternatively, if demand remains strong, the UAE could capture market share at the expense of its former partners. Either scenario introduces volatility, making long-term planning more difficult for both producers and consumers. In the long run, the UAE's departure accelerates the erosion of OPEC's power. Without the ability to enforce discipline among members, the cartel risks becoming irrelevant. This could usher in a more fragmented energy order, with national strategies replacing collective action. Price cycles may become more extreme, with periods of oversupply followed by sudden shortages. For the UAE, independence offers both risks and rewards. On the one hand, it gains autonomy to maximize revenues and pursue its own strategy. On the other hand, it loses the stabilizing influence of collective action, exposing itself to greater volatility. The success of this gamble will depend on the UAE's ability to balance hydrocarbons with diversification into renewables and alternative energy. The geopolitical implications of the UAE's exit are profound. Saudi Arabia's influence is tested as its leadership of OPEC is challenged. The departure of a close ally undermines Riyadh's ability to present a united Gulf front, particularly in the face of regional conflicts. This could weaken Saudi Arabia's leverage in global energy diplomacy. The UAE's ties with the United States and Israel are strengthened by its independence. By leaving OPEC, Abu Dhabi distances itself from a bloc often associated with anti-Western sentiment. This aligns with its broader strategy of positioning itself as a reliable partner for Western powers, particularly in security and technology. Relations with India are also enhanced. The oil for rupee arrangement gains credibility as the UAE pursues independent trade policies. This supports India's ambitions to reduce reliance on the dollar and strengthens its energy security. For the UAE, it provides a stable market and a foothold in Asia's growing demand. Globally, the UAE's departure reflects the rise of multipolarity in energy. Instead of a single cartel dictating policy, diverse alliances and bilateral agreements will shape the future. This fragmentation mirrors broader trends in geopolitics, where power is increasingly distributed among multiple centers rather than concentrated in a few blocks. Economically, the UAE's exit introduces greater price volatility. While consumers may benefit from lower prices in the medium term, producers face uncertainty. This could strain budgets in oil-dependent economies, particularly those with less diversified economies than the UAE. For Abu Dhabi, the gamble is that increased production will offset volatility, providing sufficient revenues to fund diversification. Environmentally, the decision undermines global climate goals. By expanding production, the UAE prioritizes short-term revenue over long-term sustainability. This reflects a broader tension between economic development and environmental responsibility. While the UAE invests in renewables, its commitment to maximizing oil output sends mixed signals about its role in the energy transition. For OPEC, the loss of the UAE reduces flexibility and credibility. The cartel's ability to act as a swing producer is diminished, making it harder to stabilize markets. This could accelerate the decline of OPEC as a relevant force in global energy. For the UAE, independence offers autonomy and the opportunity to strengthen global partnerships. By positioning itself as a hybrid energy hub, it seeks to balance hydrocarbons with renewables, ensuring relevance in both the old and new energy orders. Success will depend on its ability to manage volatility and maintain strategic alliances. For consumers, the implications are mixed. Lower prices may provide relief, but greater volatility introduces uncertainty. This could complicate energy planning for governments and businesses, particularly in sectors dependent on stable fuel costs. For geopolitics, the UAE's departure accelerates multipolarity. The weakening of OPEC reflects a broader shift toward diverse alliances and fragmented power structures. This reshapes the global energy order, with implications for currency systems, trade flows, and security arrangements. The UAE's exit from OPEC is more than a story about oil production. It is a geopolitical realignment with far-reaching consequences for markets, alliances, and the global energy transition. By leaving, Abu Dhabi asserts its autonomy, challenges Saudi Arabia's leadership, and positions itself as a hybrid energy power. The move weakens OPEC, introduces greater volatility, and accelerates the rise of multipolarity in energy. For the world, it signals the end of an era in which a single cartel could dictate oil policy, ushering in a new phase of fragmentation and uncertainty. And that wraps up today's deep dive from the Situation Room. If you enjoyed this breakdown, make sure to like the video, subscribe to the channel, and comment below with your thoughts. Don't forget to follow us for more global analysis and hit that notification bell so you never miss the next Situation Room update. See you in the next one.